we are going to move swiftly into the next presentation, which will focus on how we can harness venture capital to finance some of the projects that have been presented. And I'm happy to be inviting Michelle, who is the founder and the director of A Capital Idea, a strategy consultancy firm that focuses on resource diversification, investor engagement, ESG, and impact investing. Michelle has worked previously as a financial journalist with the Financial Times, after which she moved to venture capital and subsequently joined the Johannesburg Stock Exchange. Michelle is also a sessional lecturer at WBS for CAPC modules, particularly focusing on our venture philanthropy offerings. Michelle, I will also invite you to take at least 20 minutes or less if you can. Please, over to you.
Thank you very much, and thank you for the opportunity. I must say that everything that colleagues have been sharing so far today has been absolutely fascinating, and I'm certainly looking forward to playing a part in the upcoming training and core modules that we're going to be doing. So mine is to focus on targeting venture capital specifically for the financing of regional projects. I'm going to be very brief. I'm going to be talking about venture capital activity on the continent, just to provide a regional overview. Closely related, I thought it was relevant to look at impact investing activity, because certainly that would be a funder group and to be considered for a very broad range of projects, possibly much broader than one would anticipate, including infrastructural projects. I'm going to look at the infrastructure investment paradox, and talk a little bit about that, and then the bulk of my presentation, I think, will be spent on solving for underinvestment, specifically in infrastructure in the venture capital field. So then to start, venture capital deals in 2021 on the continent made up a combined total value of $5.2 billion US, which is a record-breaking year by volume and value. So this is in total, and I'm now talking about the broad gambit of venture capital on the continent. It certainly was a strong year. Value equaled that invested in the preceding year, 7 years combined by venture capitalists on the continent. It underscores two things. First of all, the industry's maturation on the continent, but secondly, the pace of investment. I mean, the acceleration is unparalleled globally. So to look at the year by numbers, just in terms of venture capital highlights, 604 unique companies participated as investors or as funders of venture capitalists. The investment stage that grew most was late stage deals. The sector focus, as one would anticipate, the vast majority of the deals were in technology or technology-enabled companies. There were 16 supersized deals, which is really of interest to those of us focusing on integration or infrastructure projects. And 4 of the African tech startups that were funded reached valuations of over $1 billion. So they were the so-called unicorns. So if you look at the percentage of deal volume and value by ticket size, we'll note that the $50 million plus category certainly gained the majority of the investment. Then to think about impact investing, and the reason that I'm doing this is because the two overlap, as we would be aware. But for those of us who are focused on targeting alternative and possibly innovative funding mechanisms or structures for our projects, even the very large projects, it certainly would be worthwhile considering impact investors and targeting them specifically. So there are more than 167 private impact investing companies. One would be aware that it's a whole lot smaller, going to be a whole lot smaller in terms of numbers of funds out there than venture capitalists. It's the total assets under management among the top 50 fund managers jumped considerably in 2020. There's been a huge amount of growth with 52% of those currently investing planning to increase their Africa exposure in the next 5 years. Now, what I'd like to focus on is the degree to which the SADC region attracts funding. Certainly, the bulk of the funding allocated to the region, as well as additional as the highest level of enthusiasm about increasing that level of investment. Now, why talk about that? Well, I'll get to that in just a moment. So there's a spectrum that we obviously are aware of when we're thinking about looking at attracting impact investors, or those that are focusing on doing on social good, with traditional grant making on the one side being a social impact purely focused investment, and then I guess on the other side, impact investing with impact, but also looking for a financial return. The ESG environmental, social, and governance compliant traditional businesses are often in this area. The interesting point and the conundrum that's alluded to, and that was alluded to by this also by the very fascinating presentation of the previous speaker, is that the private sector is under invested in infrastructure and has a particularly poor track record when it comes to closing deals on the continent, despite the investment, the infrastructure investment opportunities increasing steadily over the last 15 years. International investors have got the appetite and the funds, but the track record in moving projects to financial close is poor, with 80% of the infrastructure projects that were included in a McKinsey survey failing at the feasibility and business plan stage. So, there's the insufficient spending is really a result of the fact that despite that there's the need for funding, there's the availability of funding, and there's the pipeline of potential projects, that, as I've mentioned, the drop-off rate of funding first at the feasibility stage, where 80% of those brought to investors drop off at that point, but then in the negotiation period between and before financial close, a further 10% failed to be approved. So the reasons cited, and now let's focus specifically on revenue diversification, which is really the focus of the upcoming training modules. The volume of infrastructure and integration projects with private sector participation have really shown significant decline, despite the fact that in total there's been an increase. The private sector participation has shown significant decline following the commodity price bust after the boom. And what's really required is a rebuilding of private sector financing sources in economic development. That's our requirement from the continent. And so the question would be, for those of us who are out there pitching for projects and actually looking for alternative funding mechanisms, what is it that we should be doing or saying that is different to what we're currently doing? So though we tend in our proposals and our pitches still to be talking about the standard investment thesis elements that investors have come to expect about the young and growing population, abundant natural resources, all of which is of course entirely valid and extremely important. but frequently doesn't answer. And this is often where where my role comes in advising clients. Frequently, the kind of pitches and the kinds of proposals that we're putting together to offer to the private sector, whether it's venture capital or impact investing or other, we are we are giving insufficient attention to issues, whether perceived or actual, in project risk, looking at assessment risk, upfront costs versus return periods, etc. Insufficient mitigation strategies being put into place, or at least rather being talked about when it comes to managing for currency risk, etc. And specifically, very minimal attention in terms of in the eyes, this is a perceived issue, of course, in the eyes of many of the private sector investors who I communicate with in terms of talking through exit risk, particularly when there's a listed equity element, and making use of the SADC stock exchanges. So with all of this in mind, looking at targeting venture capital with projects for which we are seeking diversified funding presents a strong alternative. It's the availability of funding, but it's also the time is right for this, and let's just talk about a couple of the reasons. So in terms of investors coming into the market, there are a few reasons why they would struggle to why international institutional investors would struggle to come into the capital markets through the stock exchanges, through equity investments. Currently the ratings versus the risk are seen as presenting limited attraction. And then there are other issues which we will talk about in subsequent slides that limit attraction in the listed equity environment in the SADC region. But on the other hand, there's real focus by investors. Pension funds, for example, increasingly demand sustainable investing strategies from asset managers. The SDGs are seen as something which is still the SDG benefits and elements are still not seen as being entirely voiced or in the pitches and the proposals that private sector funders are seeing, but nonetheless they certainly are seen as important, and with the result that impact investing is now occupying a bigger share of the market. COVID certainly prompted a focus on businesses providing essential services, and it's also and then there's an exponential growth in demand for ESG investment options. Now these are different subsets of these factors will be good for venture capital investment into seed profit-driven projects and infrastructural projects on the continent, but certainly they should be borne in mind when it comes to putting together proposals that are targeting a private sector investor. If we look at aiming to solve for underinvestment, and we're thinking about the private sector mechanisms, the growth and the pent-up growth of infrastructure funds being run frequently out of South Africa, being run by the traditional the pension funds and asset managers, there is significant. I was in communication with the Old Mutual infrastructure fund heads who were saying, the funding is there. It's asset manager monitored. It facilitates cash flows transfers to create and in terms of creating the fund, but then in terms of the investments that are made. The infrastructure funds are frequently used to finance ground transportation networks, telecommunication infrastructure networks, and even airports and seaports. what we require would be a move to prompt the growth of the number and scope of these funds, but from the perspective of those of us who are out looking for funding, these are certainly funds that we should be and could be considering. In terms of capital market development, looking for even looking for venture capital funding of an unlisted project, or it's nonetheless the development that is required in our region's capital markets even provides is constraining the interest of the venture capital sector into the market, with technological constraints being a concern, or varying numbers or ranges of intermediaries playing in the market. So some of these factors are, of course, outside of our control as those of us who are putting together projects and pitching them to investors. But to be aware of these is important. The lack of liquidity posing a barrier to investment in securities, and prompting an exit risk, therefore, of unlisted projects through use of the stock markets and the listed equity environment. In terms of solving for underinvestment through project level proposal amendments that need to be made, awareness is required for those of us in the space of the investment criteria of the venture capitalists that we're looking at. Now, this might sound patently obvious, but it's quite notable how there's a mismatch very frequently in the proposals that are received between the particular venture capitalist mandate and investment criteria and interests, and the kind of the wording and the structuring of the proposal being received, where it's possible to pitch that exact same project using slightly different language, or using amendments of metrics, etc., to target the same venture capital outfit for funding. A persuasive impact investment thesis, we are inclined to either stray on the side of using a lot of adjectives, or of using metrics without the persuasive kind of text and argument that goes around it. We need to marry the two, looking at the return of investment substantiated by material empirical data and realistic costings. As I've mentioned previously, attention to boosting SDG factors and those that are boosted by the particular project. There's the recognition and addressing of risk factors is something that is often underplayed. So while on the one hand there's a lack of attention to the mitigation factors, there's also insufficient attention to what exactly are the benefits of the project, and what what the impact that could be made. Measuring, quantifying, and demonstrating impact. So I feel like I'm speaking to an esteemed group of people about things that are fairly basic, but it is nonetheless demonstrable that these are the very factors that are standing in the way of many of our extremely valuable and projects being turned away by the funders that we are targeting. Our proposals could also increase the recognition paid to blended finance as a fundraising avenue, and spending sufficient time and resources structuring the initial transaction and offering, so that we, in order to make the infrastructure project investable by mainstream capital, and noting that sub-Saharan Africa, as we know, is targeted in particular for blended finance transactions. that, in a very short nutshell, is what my offering for today. And Professor Moyo, thank you for the opportunity. Looking forward to learning from all the input of colleagues today, and communicating with delegates attending the courses in the upcoming months.
Thank you, Michelle. Thank you very much. And I know that you will also be going deeper into some of these instruments when we conduct the training.